All right, let's talk about something that is absolutely critical to your financial future. Today, we're going to rip the price tag right off your investments to see what they really cost, because what you pay is one of the biggest, if not the biggest, factor in what you get to keep. And the real price? Well, it's almost never the one you see on the label. Okay, let's dive in.
So let's just start with the most important question there is. After every single fee, both the ones you see and the ones you don't, gets taken out, how much of your hard-earned return actually makes it into your pocket? The answer? Well, it might genuinely shock you.
$400,000. Wow. What is that? Is that from a huge market crash? A terrible stock pick? Nope. That right there is the potential cost of fees and fees alone over a lifetime of investing. And we're going to break down step by step exactly how that happens.
Okay, so first up, let's talk about the visible price tag. This is the cost that everyone has at least heard of, but honestly, very few people truly get what it means. We're talking, of course, about the expense ratio. Think of it as the sticker price of any investment fund. But, and this is so important, that expense ratio, it's just the tip of the iceberg. I mean, yeah, it's a number you need to know, but it is a dangerously incomplete picture of the total drag on your portfolio's growth. And even just looking at that sticker price, the difference can be massive. A really cheap index fund might cost you, what, less than 0.1%? Super low. But then you look at some of these expensive, actively managed funds, and you're talking 1.5%, sometimes way more. That is a huge hurdle your money has to jump over every single year just to break even. Okay, so that's the visible stuff. But now we're going deeper. We are diving below the surface to find all the hidden costs. The stuff that's not printed on the label but can do just as much damage to your returns, maybe even more. So let me ask you a question. Let's say you've got two different funds, right? And they both have the exact same expense ratio, say 0.80%. Do they cost you the same amount? Your gut probably says, yeah, of course. But the real answer? Almost always, it's a big no. And the reason is, well, it's all of these culprits. See, that simple expense ratio doesn't tell you about the internal trading costs of fund racks up when it's buying and selling stocks. It doesn't tell you about the tax hit from capital gains. It doesn't even account for the performance drag from having too much cash just sitting on the sidelines. All these hidden things add up to a very different, true cost of ownership. Which brings us to a really key point. The actual investment vehicle you choose matters a lot. Deciding between an ETF or a mutual fund isn't just some minor detail. The way they are fundamentally built has a huge impact on your total cost. Generally speaking, ETFs are just built to be cheaper right from the ground up. They often don't have these kind of weird marketing fees like 12b1 fees that are common with mutual funds. They just have fewer layers of hidden operational costs baked in. The whole structure is just cleaner, more efficient. All right, now let's talk taxes, because for a lot of investors, this is an absolute game changer. With a mutual fund, if a bunch of other people decide to sell their shares, the manager might have to sell stocks to pay them out. Well, guess what? That can trigger capital gains that get passed on to everyone in the fund, including you, even if you never sold a thing. It's crazy. ETFs, on the other hand, have this really clever structure that helps them avoid that whole mess. Meaning, you are in control. You typically only pay taxes when you decide it's time to sell. And finally, there's flexibility. ETFs trade just like a stock. You can buy or sell them any second the market is open, giving you precise control. Mutual funds, not so much. You get one price once a day at the close of the market. That's it. Take it or leave it. And that lack of control, well, that can be a hidden cost all by itself. But hold on, we are not done peeling this onion. There is one more major layer of cost, and honestly, for a lot of people, this is the biggest one by far. We're talking about the advisory fee. So here's the thing you have to understand. You're almost never just paying one fee. If you work with a financial advisor, you're paying their fee on top of whatever the funds themselves cost. The fees stack up, and we need to see just how high that stack can go. So let's build the stack right now. You start with the base layer, the fund's cost, right? Then you stack the advisor's fee on top of that, which is often somewhere around 1%. And all of a sudden, your total all-in cost, your real drag, can easily be 1.5%, 2%, or even 2.5% every single year. And now we get to the real heart of it all, We're about to see what a seemingly small percentage does to your wealth when it compounds over decades. This, my friends, is the brutal, unforgiving math of investing.
So let's ask the big question. If your total all-in cost is 2% a year, what does that actually cost you? Not just for 1 year. I mean, over an entire investing lifetime, say 30 years. What's the real damage?
All right, let's just lay out some simple, pretty reasonable assumptions so we're all on the same page. Let's say you start with 100 grand, you invest for 30 years, and we'll assume the market delivers a hypothetical 8% average annual return before any fees are taken out. The results are absolutely staggering. With an ultra low cost, your portfolio grows to nearly $1 million. Pretty great. But with a more typical all-in cost of around 0.9%, it's almost $200,000 less. And with that 2% total drag we talked about, wow, you end up with barely more than half of what you could have had. I mean, just look at that gap.
And there it is. That's our number from the very beginning. With a 2% total fee, you give up approximately $400,000. And let me be crystal clear about this. That is not money you lost because the market went down. No, that is money that was transferred from your pocket to the financial industry simply through the slow, silent drain of fees.
So how should we think about this? Let's reframe the entire concept of investment costs. We need to give you a more powerful mental model for making decisions.
Here is the absolute key takeaway. If you remember one thing, make it this. Market returns are probabilistic. They are an uncertain gain. You hope to get them, but there's no guarantee. Costs, on the other hand, are deterministic. They are a guaranteed loss that you will pay with 100% certainty every single year, whether the market goes up, down, or sideways. Just let that sink in for a second. It means every single dollar you pay in fees is a guaranteed loss that your uncertain gains must first overcome just for you to break even. You are starting every year in a hole that you have to climb out of.
So we'll end with this. The single most important question you can ask about your portfolio is not what could it make, but this one. What is my total all-in annual cost, and is the value I'm receiving, whether it's from a fund manager and advisor, truly worth the guaranteed loss I am paying for it every single year? Answering that question honestly could be the most profitable financial decision you ever make.